Hello, I'm Bob Kaplan, Harvard Business School.
And I'm Karthik Ramanna, a professor at the University of Oxford's Blavatnik School of Government. And together we're going to present a paper on e-liability accounting. E-liability accounting is an accurate and verifiable way of measuring corporate GHG emissions, not just direct emissions, but in fact emissions incurred by the corporation throughout its supply chain. So consider the most basic decision in green energy, one to build a wind turbine to replace a coal-fired power plant. We might be thinking about the cost associated with building this wind turbine. We might be thinking about all of the downstream benefits yielded by decarbonizing the grid. But what we still don't know to this day is what is the total GHG impact of building a wind turbine relative to continuing to run a coal-fired power plant. That is to say, what is the total impact as you look up the entire supply chain of a wind turbine? This would include the minerals necessary to mine the metals that will eventually go into the wind turbine. This will include all of the concrete that might be necessary for that process. As you think about that entire set of incurred emissions, does the operating cost or the operating emissions impact of a wind turbine actually make up for that of a coal-fired power plant? This is the sort of question that we want to ask and answer, calculating the total GHG impact of any product or service. And it turns out this is not just an engineering problem. This is an accounting problem, a problem of a rigorous GHG accounting. And GHG accounting might sound like a really boring subject, but it is one of the most basic and important issues involved in solving climate change. Why? Because unless you measure something reliably and report it at the level at which people make decisions, for instance, the decision to buy a wind turbine, or more recently, Congress has passed a bill that incentivizes people to buy electric cars, so we would be able to do an e-liability accounting of an electric car. Unless you measure the total impact of environmental impact of products and services at the level at which decisions are made, people can't be expected to modify their decisions. We know this is the case with costs, and we believe this is the case with climate change as well. In fact, if you look at the issue of managing climate change in the market economy, controlling supply chain emissions is far more important than perhaps controlling the direct emissions of any one entity. Because for the vast majority of entities outside of the fossil fuels industry, the ratio of supply chain emissions to direct emissions is greater than 1. And in fact, for the average one of these entities, according to data from the Rocky Mountain Institute, it is over 5. That ratio is over 5. For companies like Amazon and Walmart that are in the retail sector, that ratio is close to 11, which is to say that most of the impact of GHG emissions for most companies in the real economy is happening in their supply chains. And finding a way to reliably and verifiably measure these accounting impacts in the supply chain is what we need to do to address climate change. So one question that might be on your mind is, isn't there already a way to do this? And there is something called the GHG protocol, which is the dominant GHG accounting standard out there. The GHG protocol was conceived about 20 years ago at a time when very few people, and certainly very few major companies, were thinking very seriously about climate change. And so it was with perhaps great intentions that they decided to create an approach to GHG accounting around what they call scopes. So let's just quickly talk about what these 3 scopes are, because there are 3 in the GHG protocol. The first is called, perhaps predictably, Scope 1. And Scope 1 relates to all of the direct GHG emissions from sources that are owned or controlled by a company. So for instance, this could be if a company is operating a fleet of motor vehicles, then the emissions associated with that fleet of motor vehicles would be its Scope 1 emission. So these are just direct emissions. And in fact, the Scope 1 emissions measured across the entire economy, the sum total of that, is in fact the total emissions that are in the economy. So on one level, scope 1 is all that matters. But of course, as we mentioned, for the vast majority of companies, scope 1 is a small part of their total footprint. Much of their emissions impact is happening upstream in their value chain. And of course, some of it is happening downstream as well. So you have something called scope 3, which is another type of scope within the GHG protocol, which measures indirect GHG emissions. So scope 1 measures direct GHG emissions, and scope 3 measures indirect GHG emissions, both upstream, that is to say from suppliers and the suppliers and so forth, as well as downstream, which is to say customers and customers and so forth. And you might wonder, wait a minute, you said there were 3 scopes, you talked about scope 1 and you talked about scope 3, but you missed one, you didn't talk about scope 2. Well, yes, of course, there is something called scope 2, you can infer that. And scope 2 is actually a special subclass of scope 3. It refers just to GHG emissions that are attributed to electricity and heat that is purchased by an entity. So when you have an entity purchasing electricity and heat from its, say, grid or from its natural gas suppliers, then those emissions are called scope 2 emissions. And you might wonder, why are those scope 2 emissions a special class of supply chain emissions carved out from scope 3? But part of the answer is going to lie in all of the complexities associated with scope 3 accounting. And Bob is going to walk us through some of those complexities now.
Yeah, but just to anticipate, Karthik and I suspect that the origin of scope 2 is that it was the only scope 3 emissions that the creators of the greenhouse gas protocol knew how to measure. And everything else was kind of out there philosophically. They'd like to do it, but not really sure how to do it. And in fact, that uncertainty was well founded because they couldn't measure it. And 18 months ago, when Karthik and I started to work on this and got exposed to all the scopes, and we independently and simultaneously agreed, this can't work. And it can't work in any realistic supply chain. So as an example, take a company, a supplier in the middle of a very long supply chain, in this case, automobile supplier, say it's making car doors. Well, for them to measure all of their first upstream supply emissions, they'd have to know who mined the minerals, the ore, the metallurgical coal that might have been used to produce steel. They'd have to know which shipping company moved all of those minerals to get to a steel company, and which steel company it was. And then the transportation to them. But then also, if they have to think about downstream, they have to worry, well, what is Toyota or BMW going to be doing with this car? How do they put it together? And then what are the drivers who are going to drive the car going to be doing with it? And this is an incredibly complex job to start calling up and trying to get data from all these places. I mean, an automobile company or an airplane manufacturing company, has 15 to 20,000 components, 10 to 15,000 suppliers, many of whom they don't even know. They're 2 or 3 tiers away from them, either upstream or downstream. How can they possibly find out this information? It seems like an impossible task. And so as we got into the scope 3 to figure out how could they imagine they do this, we realized that in a way that they admitted that they couldn't do this. And in the standard, they allowed companies to say, well, if you can't really measure the actual emissions upstream and downstream, then you can use what they call secondary data, use average data from industries or consultants who provide you with this. And that's the way, in a way, this problem has been finessed. But this is not an accounting solution. I mean, for those of you in the audience that have been exposed to accounting, imagine having an accounting standard that says, well, we really want you to measure the actual cost of the materials and services you buy. But if you find it difficult to do that, well, then just use average. I mean, can you imagine that we're going to run a market system where everybody is using industry average data and you don't know the specific costs of the materials that companies are buying or the services that they're buying? This wouldn't be acceptable. But yet this is the prevailing standard now. You also notice, if you go back to the previous slide, that any given emission in the supply chain is counted by every single entity in the supply chain. And so if you have a 10 deep supply chain, a given emission is counted 10 times. Now, when we point this out to the greenhouse gas protocol enthusiasts, they say, well, that's okay, but at least it's being measured. But the multiple counting is actually a serious problem, as increasingly companies are signing up to net zero targets, which says we're going to reduce all the emissions, both our own and our supply chain and customers, to zero over some period in the next 20 years. Well, if you do this, imagine that all you need is, let's suppose there's 10 kilograms of CO2 emissions that save somewhere in the supply chain. Now you have 10 companies counting that same emission. So now you have 100 kilograms being counted to net zero targets, even though only 10 kilograms was saved. Because as Karthik said, the only emissions that get to the atmosphere are scope 1 emissions. And yet every company in the supply and distribution chain is claiming credit for those 10 kilograms of emissions. And so there's really a serious flaw in that. And then the final part, as we thought about this even some more, is this symmetric treatment between your upstream emissions of your supply chain and your downstream emissions of your customers and your distribution chain. Now, if we do expect, and you'll see that we want companies to control their supply chain emissions, they do have control of that, because they can control the design of their products and which components and which services they embed in their products. And they also choose which suppliers they're going to purchase from. And so they have the opportunity of purchasing from lower emitting suppliers for the same product or service. So a great deal of control. But companies have virtually no control over how the customers are going to use their products, and they don't even know who their customers' customers are. So they have no knowledge of them, and certainly they have virtually no control over how their customers are going to use the product or embed it in their own products and services. So we have these three, really significant problems that are inherent to the Scope 3 standard. So one of our collaborators has said, Scope 3 is a very nice rhetorical device. It got people thinking about supply chain and downstream emissions, but it's not a very practical measurement device, and certainly not accounting. And again, simultaneously and independently, Karthik and I realized that this is actually an easy problem to solve, at least, the supplier side, because it's just inventory accounting. It's things that accountants have been doing for decades, if not centuries. And the key insight is not to look at the entity as the unit of analysis for measuring greenhouse gas emissions, but to look at the outputs of the entity and have the greenhouse gas encoded into the output. And that way, when the output gets sold, transferred to the next organization, further downstream, they will take on the accountability for all the emissions that have been accumulated to that point, and then the ones that they add into the product, into their products and services, and then transfer up to their customers, who then will have this accumulated amount of emissions in the products and services. So if you just take, you excuse the use of T accounts, but accountants, sometimes that's the simple way, you could actually have, for each company, is what was the starting amount of their e-liability, accumulated greenhouse gases that they have not yet transferred upstream. You'll see where this comes from. How much they purchase from all their tier one suppliers, all of whom they obviously know. We don't have to go on a search to figure out who your tier one supplier is. Then we have our scope 1 emissions, where we produce emissions within our own assets. Now we have finished goods, and when we transfer the finished goods, then that gets transferred out to whoever's purchased them from us, including maybe the transportation and distribution company that's moving it to the next stage. And in the same way that inventory costs move up a supply chain, we'll have these accumulated emissions moving, from original sources, extracting minerals out of the ground, all the way to the end use consumer. And so it's a combination of inventory accounting, as we said, but cost accounting within the company. As you can see here on the left-hand slide of slide 9, what we do in cost accounting is take site-wide expenses and drive those analytically and logically using approaches such as activity-based costing to all the individual outputs we produce with those common assets, as well as the purchased products and services that are going into this production function. So we already know how to do this cost accounting of taking, except in this case, it's GHG accounting. Instead of using currency, we'll use kilograms of CO2 or CH4 or CO2 equivalents, whatever units you want to be measuring it. And then, so we'll have this product by product, and then on our aggregate inventory account, we'll have everything that happened in this period. What was our opening e-liability balance? How much did we acquire through purchases of products and services? So electricity as a service, steel, glass, fabric, electronics that are going into this car door, or tangible products. How much did we generate on our own assets and our production process? Now, the one thing that we can do that's actually very interesting here is if companies are purchasing carbon offsets, figuratively planting trees in the Amazon, though it's not as simple as that, but we can think about that image. Well, that's a reduction in the greenhouse gases, and they should be entitled to reduce the greenhouse gases then that are embedded in their final products and sold to their next tier of customers. So this system automatically accommodates the carbon credits that companies might want to do, or if they're doing carbon capture, they grab a lot of carbon out of the air. Well, that's good too. That's a subtraction from their e-liability account. So we're pretty excited because it's such a simple solution to this extremely important problem.
So one of the reasons why we're so excited about this product, e-liability accounting, is that it can actually be audited. It means that e-liability statements that companies put out can be audited to what is called the fairly presented standard or the true and fair standard of auditing that we're used to in the context of financial statements, in the context of audits that you see on, say, a company's IFRS financials or a company's FASB financials. So why is that important? You say, well, why do we need these sorts of audits? Well, in part because if a financial statement is auditable, and if an e-liability statement is auditable in that same sense, then we can start writing supply chain contracts on it. If you think about it, something like an iPhone has thousands of components across many, many tiers of suppliers. And yet a company like Apple can control down to the nanocent what is the cost of its iPhone, what is the cost of those components. And the reason it can do that is because it can write rigorous supply chain contracts with all of its thousands of suppliers. In the same way, a company, if there's auditing of e-liability, can write rigorous supply chain contracts to control what is the environmental impact of the product that will transfer on to its customers or eventually to the end consumer. So how?
Yeah, and Carl, and as another extremely important component of the auditing, it means you can have the same validity and integrity to your environmental numbers that you have in your financial numbers. And the way the Scope 3 is written today and the standards that are used for Scope 3, no auditor could really sign up to a fairly presented opinion, right, which means that the environmental reports, by its very nature, are going to be inferior, having lower validity and lower integrity, which we don't want. We want regulators and customers and investors and consumers to have the same feelings of confidence in the environmental numbers that they have today in the financial.
That's absolutely right. And in fact, most companies that put out so-called ESG reports these days don't have audits. To the extent that they do have audits, they have what are called not obviously false audits, which are double negatives. And you say, well, what does that even mean? It means that when a company says that its Scope 3 impact is, say, 100 tons of CO2 equivalent, for instance, then all the auditor can say is that number is not obviously false. It's not obviously made up. But what the auditor cannot say is if that 100 tons of CO2 equivalent reported as a scope 3 is anything close to what is the true economic, or in this case, true environmental impact of that particular company. That's what's so important in this process. It's the integrity of the accounting that then allows you to be able to drive innovation in supply chains. So how would an e-liability audit work? Well, it would work very simply analogous to an accounts payable audit, because as Bob mentioned in slide 9, basically what you see in an e-liability statement that's reported is a closing balance, an opening balance, and then changes in between that result in the difference between the opening and the closing balance. So we will know as an auditor what the opening balance is. We need to verify that the closing balance reported by the company is in fact true. And you will use things like the receipts for transferring in of inventories, as well as the receipts with customers when you transfer out finished goods, to verify what are the e-liabilities transferred in and out. The part that will require a special kind of verification is the e-liabilities generated from so-called scope 1 activities, because these are direct emissions generated by the company at its own site. And if the company has a particularly innovative production technology, for instance, it's able to reduce the emissions to produce a widget relative to everybody else in the industry, then the auditor should go in and audit that scope 1 process. Likewise, if the company is claiming offsets from its production process because it says it's planted a lot of trees, the auditor can go in and audit that. But that audit process will look very similar to the kind of audit you see on accounts payable. So now if we move to slide 11, we'll be able to see next to each other, face by face, what are the advantages of the e-liability approach and how it addresses some of the well-known disadvantages of scope 3 that Bob's already talked about. So as we said earlier, scope 3 violates the most basic principle in accounting, which is the entity concept. And that results in the multiple counting of the same emissions many times in a supply chain or in a value chain. And of course, scope 3 allows companies to report industry average emissions as their own, which means that any competitive advantage from emissions reduction is immediately obviated away. So the way the e-liability approach addresses this through eliminating multiple counting in the system, by creating an incentive-compatible transfer of emissions through a supply chain, by accommodating a rigorous process for contra-emissions or offsets, and by running on effectively the existing accounting and auditing systems. So because the e-liability reporting can run on inventory accounting systems, because it can run using cost accounting software that the company already has, it can be reasonably cost effective to run an e-liability system, perhaps much more so for the same degree of accuracy that would be needed in scope 3. Because it also integrates in the way we already do accounting analysis for, say, things like inventory and cost of goods sold, the financial analyst community will be familiar with how to use this data to make estimates of the competitiveness of a company. So we don't need to go back and re-educate a whole bunch of people in the asset management industry on how to use data that comes out of the e-liability system, because it uses the same principles as inventory and cost accounting. And importantly, e-liability can define the GHG materiality of a company independently of its financial materiality, if that's the direction that regulators want them to take. Of course, different jurisdictions might have different views on that. And of course, carbon border adjustments are becoming increasingly popular as a bipartisan solution to climate change in the United States. Well, if you want to go with a carbon border adjustment, you need to have something to tax. What is the basis on which you would run this taxation? Well, e-liability would provide you a basis for taxation of a carbon border adjustment, or indeed any other kind of taxation, whether it's a value-add tax, whether it's a consumer-focused use tax or sales tax. You need a basis for taxation, and e-liability provides an auditable basis for that. Now, one of the questions that does come up as we talk about the advantages of e-liability about scope 3 is that scope 3 measures not just upstream or supply chain emissions, but also downstream and customer-related emissions. And so one question that we get often asked is, what about downstream? Why is e-liability not counting downstream? So Bob's going to take us through that.
Yeah, so I've already talked about some of this is the much lower controllability that a company has, plus the difficulty of tracing it. Through this inventory method that we have set up, there's no problem. We can measure greenhouse gases across the most complex supply chains all over the world just by using these fundamental inventory principles. But we don't have any principles to establish what happens once we transfer products and services to customers, and we don't have control over them. Now, companies can estimate this, but it's still going to be, it's like forecasting with a financial statement that has a much lower degree of reliability and integrity than the transactions that have already occurred to date. And so if you want to think about downstream emissions, and they're not irrelevant, recognize they have just very different quality of data and measurability here. And in fact, but companies that do feel that they can make a difference downstream, well, they should be they should feel free to disclose that. Nothing stops them from disclosing it. We talked to a food manufacturer, made rice, and they said they changed the recipe for the rice and the ingredients so that consumers can cook the rice in 3 minutes versus 30 minutes. Well, that's a 90% savings in the gas that's being consumed, the electricity that's being consumed to produce that rice, and they should take credit for that. But that's a different kind of standard than measuring, all the greenhouse gases that went into the production and distribution of the rice, getting it in the box that gets it to the customer. So what we've been talking about with the regulators and standard setters is you don't have to ignore downstream, but it's a very different type of concept, and develop standards specific for the nature of downstream, because we already have a complete accounting solution for upstream and owned company emissions. And you don't want to distort those. You want to hold on to those. And then separately, you can think about how to get the disclosure on the downstream. So Karthik, what happens next? So what's happened since we published our Harvard Business Review article and then an update is we've actually been working on companies to see how this works in practice. Is this feasible? How much work is involved? Is it giving data that's meaningful to the managers? And we've also been advocating to various standard setters that don't go out on a limb on scope 3 requirements, because we're going to cut it off behind you, and you're going to fall down and be embarrassed by this. You can get companies started thinking about supply chains if they haven't thought about it before. That would be a good thing to do. Maybe you need to start with industry average data just to get in the ballpark and understand what's going on across all your products and services. But don't institutionalize this into a standard, and actually encourage them to get to this more accurate approach over a 3-year period, and encourage them to, as much as possible, start getting actual data from their suppliers and start reporting it, perhaps with the safe harbor provision that the SEC has put out in its exposure draft.
Excellent. So what's our theory of change? Well, look, there are lots of problems in the world today, and many of them seem completely intractable. But one of the most urgent problems that we all face as a planet is climate change. And we actually think that the good news is that this most urgent problem has actually a pretty simple solution within sight, which is the deploying of centuries-old inventory technology and, decades-old cost accounting technology to measure reliably and verifiably carbon of companies in supply chains in a way in which customers can make decisions on it. So suddenly this becomes the basis for companies to compete on emissions excellence, just like they compete on cost or quality or something else. And our vision, our hope is that by the end of this decade, we effectively have gotten to a place where it's second nature for companies to be using e-liability to compete on their emissions efficiency. And it's second nature for customers and consumers to be demanding this information, just as they demand price and quality information. Now, the thing... Sorry.
And in fact, this is the only way to set off the competitive dynamics to decarbonize company supply chains. So there's a lot of rhetoric about doing this, but if you don't have good measurement approaches, it's not going to happen. I mean, now we have a path forward for this to occur.
But the thing is that, when this process evolved in the context of financial accounting, and there have been many historians that have track the evolution of capitalism to the evolution of financial accounting. And they say capitalism and market societies got more sophisticated and wealthier as the quality of accounting improved. But that process took hundreds of years. And the accounting rules were socially constructed. They were legitimized through bottom-up processes. As people saw their value, they got institutionalized by regulation. And so financial accounting played this very important role in the development of the modern world as we know it. The challenge, of course, is that we don't have hundreds of years to solve climate change. I mean, if we believe the scientists' data, and there's no reason not to, we don't have much time at all. And so this process that we know worked well in the context of financial accounting, we've got to find a way to turbocharge that process and run it in a very short period in the context of GHG accounting. The good news is we know it works. So what we're trying to do now through our work with companies, through a not-for-profit agency, is to encourage very sophisticated and highly motivated companies to drive this e-liability system at scale. And what we're going to share with you in the last few minutes is the results of some early pilot studies with two pioneering companies that have taken us up on this challenge. The first one of these is a global tire company that has its operations primarily based in Southeast Asia. And here on slide 16, you see a simplified representation of the tire manufacturing process, which is a standard industry kind of representation, but as customized by this particular company. And, as you would imagine, as with any complex process, there are hundreds of inputs. In fact, this particular tire company has about 200 suppliers and 200 different inputs, effectively. And of course, there are many different processes associated as you take these raw materials across 200 suppliers and inputs and you put them into different processes. And then you run your own, you have your own scope 2 emissions, that is to say, the use of purchased electricity and heat in order to run the tire curing, the tire bonding, and the final sort of production process that results in the tire that you can sell on to an automobile company. And so when a company starts to think about running a pilot, as this company did, the first question they asked us, where they were very enthusiastic about the idea, they said, we'd like to try it. But do we really have to call up all of our 200 suppliers and ask them for supplier-specific data? And do they have to what if they have 200 suppliers? Do they have to call up their 200 suppliers? How is this going to work? And this is where we pulled out an old rule that Bob actually had described in the context of some of his earlier work in cost accounting. And it's called the Willie Sutton rule. And Willie Sutton was a famous bank robber. When he was finally caught and asked, why does he rob banks and not, say, houses where there's less security? He said, well, that's because there's money in the banks. And so the Willie Sutton rule is basically focus on where the impact is, focus on where the magnitudes are. And it turns out in the context of the tire manufacturing process that just a handful of suppliers and a handful of inputs account for the vast majority of emissions. So it turns out that carbon black, synthetic rubber, natural rubber, and steel products, just these four inputs, account for almost 85% or even more than 85% of the emissions. So if you've got 200 suppliers, but it turns out only 4 of those suppliers account for 85% of your supply chain emissions, then the Willie Sutton rule is focus on those 4. And as long as none of your competitors are doing it, 85% efficiency in the process is more than enough. As more and more of your competitors start producing e-liabilities, then of course you're going to have to look at where you can add value, and that's when you would start iterating into other suppliers in your supply chain. So what we present here on slide 17 is some camouflage data from this company. So obviously to protect its competitive interests, what we've done is normalize the data to a unit, it's a simple unit of 1. This is the value marked in yellow. So don't actually read the values on the table for their magnitudes, but read them for their relative impact. And I won't go into the technical elements of this in great detail, but what I'll suggest is 2 things. One, as the company started to talk to its top 5 suppliers of carbon black, synthetic and natural rubber, steel products, and synthetic textiles, and asked them for supplier-specific emissions data, those suppliers themselves came back to the company and said, well, if you want to know about supplier-specific emissions data for the inputs we are sending you, we also want to make you aware of these low emission inputs that you don't buy, that we offer in our product line, that we could make these low emissions inputs available to you. So in that first column you see on the first graph you see, or table you see on slide 17, you see the inputs as rows, and then you see the percentage of the input to the total weight of the output in the second column. And then in the third column, you see the currently normalized data on carbon footprint of those inputs. But 3 of those suppliers came back and said, here are some cleaner inputs that we can make available to you as well. And as the company went through the e-liability pilot, it looked at the various sources of Scope 1 emissions in its own direct operations. And it said, yes, of course, there are lots of Scope 1 emission sources in our company, but if we're going to focus on the Willie-Sutton rule, let's focus on the big source of emissions. And for tire manufacturing, the big source of emissions is the tire curing process, because this is a tremendously heat-intensive process that requires, in the case of this company, drawing on electricity to generate that heat from its grid. And because this company is based in Southeast Asia, the grid there uses primarily coal-based electricity. So they're using a lot of their Scope 1 impact is coming from, well, effectively this is Scope 2, but they're counting it as their direct impact, is coming from the use of purchased electricity from a grid that is based on coal. So they said, okay, let us focus on some alternative sources of energy, alternative sources of electricity. So the first thing they said is, what if we put some solar panels on the surface of on the roof of our factory? What will be the GHG impact of those solar panels, and how will that impact our efficiency, our emissions efficiency of the tire curing process? And that's what you see in the second table, in the lower table on slide 17. But as they were looking at that, they said, well, some of our heating machines in the curing process are quite old. What if we replace them with newer, more energy efficient machines? Those machines would turn out not only would take much less electricity, well, 5% less, not much less, they would also take somewhat less natural gas because they use both electricity and natural gas. So as the company started this process of running an e-liability pilot, the process of measuring these things at the accurate level that would require auditing, that would pass the level of auditing or a test of auditing, started asking them or getting them to ask questions about where the emission savings were possible. And as they went through all of the various options in emission savings in inputs, emission savings in the electricity process, emission savings in the kinds of boilers they used, they came to a conclusion that they could produce the same tire that they produce, the standard passenger car tire, for somewhere between 20 to 25% less emissions. Now, of course, this will come at a cost because installing, for instance, solar panels will come at a cost. Installing new boilers for their tire curing process will come at a cost. Some of the low emissions inputs we talked about in the first table will be more costly. So part of what now the company is in the process of doing is figuring out how does it take this 20 to 25% emission savings and have a conversation with its customers about volumes, for instance. Maybe the customer will buy more volumes of these low emission tires that allows the company to justify the additional cost. Or maybe the company, the customer is willing to pay a premium for the low emissions tire because this particular tire company sells to luxury car makers. And some of the consumers of those luxury car makers might well pay a premium knowing that there are low emission tires involved. So it goes back to that old adage of managers manage what is measured. And as you build in a rigorous system of measuring emissions through the e-liability, you end up seeing lots of places in which companies can change their strategy and have conversations with their value chain on how those strategic changes can be passed down to create real value. There's a second pilot that we've been talking about, and Bob's going to introduce that.
So the second pilot, I'll try to get through this quickly. It's a very similar message, but very different setting. This is for a company that makes cement and then process, and that gets ready for make into concrete on construction projects. Cement, very old product. Portland cement was invented 200 years ago. Completely commodity product. But in emissions, cement produces more carbon emissions than any country in the planet except China and the US. So if cement were a country, it would be the third largest emitter in the world. So this is kind of the Willie Sutton rule applied to where do we want to look here. Relatively simple process is diagrammed here on slide 18. Basic key ingredient is limestone. You have to heat limestone up, change it to produce something called clinker, term I never heard before, and a lot of CO2 associated with grinding it up and producing this clinker. And then clinker is mixed with some other stuff to make cement. It's milled, ground together. And then the final cement is mixed with other, what's called aggregates, sand and gravel, and goes to a big concrete mixing truck that we see on construction projects. And it turns out this company was already looking in what would be called the e-liability method on its own because it wanted to do better than scope 3. It wanted to produce to a higher standard. So we actually had a head start there. So these are disguised data for one of the plants of this very large cement company. And there's a total of 200,000, say, tons of CO2 emissions equivalent at this plant. Much of it produces itself, the direct because of the heating and crushing of the limestone and grinding the cement. But there's some that's purchased, particularly slag, which is getting mixed in with the cement to produce, it's produced with the clinker to produce the cement. And so there are three basic production processes. So this illustrates the cost accounting story. The tire company is really the purchasing and inventory accounting story. And you can see of the 200,000, about 90% of them is associated with clinker production and a small amount in grinding the slag to mix with the clinker into the cement. And so clinker, this has a lot of gases. Now, the interesting thing is their usual cement, that's called CEM 1, the basic cement commodity product that they're selling and making into the concrete, actually produce, and the actual amount is disguised, but there's a lot of tons of CO2 per ton of cement, okay? But they turn out, you can have different mixtures. They have different recipes they could use. And instead of putting as much cement into the mix that goes into the concrete, they can bring in some of this slag, which has a lower GHG footprint. And you can see as it goes from this first traditional commodity version to CEM 3, has much lower clinker because you're using much more slag in there, but it has basically the same properties. I mean, the only difference is it takes longer to cure on site. So here we have this hundreds of year old product, but now for the first time, they're thinking about innovation. They're thinking about, let's not make it with 100% cement, let's add in some slag and do that and talk with the customers in the same way that the tire company is talking with them. And in another study, I'm doing another study with another supplier to the cement concrete business. There's a technique you can use that actually substitutes recycled glass, consumer glass that you get out, you can take out, the blue cartons, at least in the US, that get picked up once every other week. And they recycle that, and that substitutes for the cement. And the recycled glass essentially has a zero footprint because it's all been used in the initial version of the glass. And they could substitute as much as 50% of the cement in a concrete mix. And so here's all this, what could be more boring and mature than making cement? And yet there's all this possible innovation that could go on once we get measurements and once customers and investors really care about this. So, where are we trying to work? If those of you academics want to get into this, where should you be looking? We talked about the Willie Sutton rule. Find out where there's a lot of scope 1 emissions, either in your own operations or in your supply chain, and look for where the innovations are coming. Organizations that can produce the same output with a 30 or 40% lower greenhouse gas footprint, own operations and a supply chain. And so it becomes a competitive advantage, particularly if they have GHG sensitive customers and investors. So just to summarize, it's not that arduous to become a pilot. Focus on a few key inputs, steel, cement, limestone, clinker, synthetic polymer, carbon black. Work with those suppliers. You can go through the same pilot. It's not going to take that long to do. And we can get quite valid, accurate measurements, which you can quickly leverage with your customers, into a competitive advantage. So final words, Karthik, for the academics, regulators, business people on this call.
So we're obviously driving forward with this. We think that the e-liability system offers a very simple and clear way in which we can measure carbon in supply chains. Hopefully these 2 pilot studies will show you how easy it is to get started on this. Of course, there will be a journey, but this is a journey that we can help you with, and we are keen to do so through this not-for-profit that we have initiated. We should also mention that on the 2 pilots we described, we've been working with our colleague and co-author, Stefan Reichelstein, who is a professor at Stanford. And one of the things that Bob and I are now continuing on is to think about accounting for carbon offsets. Because as we said, when we built the e-liability system, one of the things we wanted was a system that would also work with offsets. The problem, of course, is that offsets present a whole different set of accounting challenges. One of the challenges with offsets is that not all of the public goods associated with e-liability, the e-asset, that is to say, are in fact fully capitalized. So how do you create a system for accounting for offsets when you've got partial capitalization of the underlying natural capital? And how do you avoid the perverse situations where people are sort of destroying, for instance, public forests in order to claim an e-liability offset? So we definitely don't want that. We should also be thinking rigorously about how to account for timing differences and the uncertainty in offset delivery, including issues like leakage in natural capital offsets, and how to think about which offsets are alienable from the underlying operating activity and thus lend themselves to transaction or trades on secondary markets. Obviously, you want to create a secondary market for offsets so that that allows for efficient allocation of productive resources and economies. But we should think about this alienability principle very carefully. And that's a feature of some work that Bob and I are now doing with another co-author who also happens to be based at Stanford. And we're also, Bob mentioned briefly the issue of downstream and how to think about downstream. Earlier, we mentioned that this is something that doesn't lend itself to rigorous accounting, but it can lend itself to voluntary disclosure. So what might a reliable framework for comparable voluntary disclosure of corporate downstream emissions look like? That could be another area for research and also for companies that are really innovative in this space to engage with. And
so it's an incredibly exciting time, I think, to be an accounting academic and look at this whole new sphere and of work and unit of measurement in a problem of such societal importance. So we hope we've inspired some of you to pursue this. And even if you don't pursue it, as we produce cases, and we have cases underway, we hope you'll teach it so that your students will be able to understand these key concepts and how accounting principles can be applied to the measurement and the auditability of companies' greenhouse gas emissions, their own and their controllable ones in their supply chain.
Thank you very much. And if you have any questions, don't hesitate to email either Bob or me.